For more on the jobs or lack of jobs and the economy, we're joined by Daniil Manaenkov, the head of U.S. forecasting on the economic unit of the RSQE at the University of Michigan. Welcome back to the show. Happy New Year. The investors, they looked at these numbers and they were happy for a few hours, then they got less happy. What were in the numbers that caused so much concern?
Right. Thanks for having me back. First, it's the revisions because at the face, 216 jobs is good, but we gave back about 70,000 jobs on November and October readings, and that's been the trend for the past year. So maybe people are a little bit skeptical that well, overall it was a decent report. Now, the second beat of news that may have investors maybe looking for revised expectations of what the Fed is going to do is what happened to wages. So we had a little bit of a gyration in wage growth for the past couple of months, largely because of the strike by UAW. So when like 30,000 workers were on strike, average got a little bit revised down. When they returned, average wage jumped. And the expectation was that we're going to be more in line with what we've been seeing before the strike. That was like pace of wage gains about, I don't know, 3.5% at annual rate. And
right.
Now we got a reading of about 5%, which is plenty, and the Fed should be worried.
Okay, you say the Fed should be worried, but you just highlighted, I guess, some of the issues. This is perplexing to a lot of folks who watch this very carefully. You've got a job market that is arguably softening, but that you have wages, at 4 or 5%, depending on which number you look at. The two don't seem to make sense. If the job market is softening, wouldn't wages remain essentially flat? In other words, employers would have more leverage on the wages rather than the other way around?
Ultimately, yes, but what we may be seeing right now could be an echo of a very, very strong market that we've had for the past 2 years. So people don't negotiate. I mean, the labor market does not adjust immediately. It's a little bit backward looking. So it makes sense for wages to keep going hot for at least a bit until the job market softens further. But the Fed should still be somewhat, paying a lot of attention to what's happening to wages, because we've had several high-profile unions negotiate, double-digit rate wage increases over the past several months. And those definitely translated to some non-union workers who compete with those union workers. So it's possible that we may still be seeing a lot of impulse to wages from the past tight labor market.
The general investor sentiment is that rates will be cut starting sometime around March or April, right? We can argue about that, but that's what the expectation is.
Right.
They're not going to cut rates if inflation isn't 100% under control, and they said that at the last meeting minutes, that there's still some question marks there. That said, if it's the wages could go up, but inflation could go down if it's a lagging indicator, as you say. Are investors having the right expectations?
So I think in general, investors run a little bit ahead of the curve. So as of yesterday, before the jobs report, I think the median was for expected six cuts by the end of December of 2024, when the Fed themselves sort of indicated maybe 3 cuts. So there was some disconnect there already. Before COVID, say in the decade after the Great Recession, wages weren't really affecting what's happening to inflation. So it's possible that the wages could still remain hot, but inflation will basically settle into the 2% range. So it's definitely a possibility. But it's a risk that wages will start translating into higher inflation pressures as well. So the Fed is going to have to keep a close watch on both. And I mean, news on inflation were pretty good over the past several months. So we got some good readings, we got some good revisions of the past data to some series that the Fed pays attention to. So at this point, inflation is probably a risk, and it seems like so the center point is that the Fed is probably going to achieve a soft landing like they hope to, but they're going to keep watching for some signals here and there that may, undermine that outlook. So I think at this point, the labor market is actually going to be the focus of everybody, because if inflation is roughly under control, the Fed is going to switch to paying attention to any indicators of that the labor market is softening.
And if you think about where investors are positioning themselves, a lot of the investments that were interest rate sensitive took a real hammering last year. Now, albeit they've recovered a little bit from that. And you look out at 2024, 2025, I saw the 10-year, I think, right around 4%. So what does that tell investors if the 10-year is still at 4%? Because the stock market is saying one thing, but the bond market is kind of saying another thing.
Yeah, there's some. All right, so the overall picture is still quite a bit confusing. So it's possible that we're going to blow out all the expectations for softening of economic growth, and we're going to kind of see continued strong growth for the next year or two, which may necessitate the Fed to, abandon any plans of cuts and just keep the rates at their level. So there's another puzzle, at least to me, that when you look at, say, the Fed's long-run projections of where long-run interest rates are expected or supposed to go, they're showing that they're going to go down to like 2.5%, which, if you assume that we are in a stable inflation world, means that the real interest rate is going to go down to 0.5%. Historically, it's not been there. So I personally would not bet on interest rates going down quickly. So I think we're going to be in a world between like maybe 3 and 4% long-term rates for a while now.